All right, let's talk about what's really going on. You've probably seen all the headlines about geopolitical tension, right? But while everyone's focused on that, something huge has been happening, kind of quietly in the background, deep in the plumbing of the financial markets. So let's just start with one number, just one: 65,463%. I mean, just let that sink in for a second. That's a growth rate so absolutely massive, it's kind of hard to even wrap your head around. So the big question is, what on earth could possibly grow that much in just the first 3 months of this year? The answer? Well, the answer points to this massive shift away from the old school Wall Street 9 to 5 world and into something totally new, a 24/7, always on financial system. And I'm willing to bet it's not what you think it is. Okay, so what we're talking about here is this new kind of crypto-style contract. But not for crypto. We're talking about contracts for really traditional stuff. Gold, oil, even currencies. And according to this huge new report from BitMEX Research, their growth hasn't just been fast. No, it's been, well, explosive is probably the only word for it. And this is where it gets really wild. Just look at the scale of this jump. At the start of January this year, the weekly trading volume for these commodity contracts was around $38 million. Not nothing, but modest. By the end of March, it hit an unbelievable $25 billion. That's billion with a B. And no, that is not a typo. And, this wasn't just one random asset that went crazy. The volume was spread out. By the middle of March, silver actually took a surprising lead, grabbing almost 35% of the market. And right on its heels were crude oil and gold, both with over a quarter of the volume each. So a real broad-based move. So here's the bottom line. These things, people are calling them TradFi perps. That's short for traditional finance perpetuals. This isn't some tiny little experiment anymore. Not at all. In just a few months, they've ballooned to make up nearly 2% of the entire crypto derivatives market. And that, of course, leads to the biggest question of all. Why is this happening? And why is it all happening right now? Okay, let's get into the why. Because the reason for this 65,000% explosion, it wasn't some flashy new technology. Nope. It was a global crisis that shined a giant spotlight on a fundamental flaw in the old financial system. And that flaw is the weekend. I mean, think about it. Geopolitical crises don't exactly clock out at 5 p.m. on a Friday. As the conflict between the US and Iran got more and more intense, oil prices went haywire. And the real kicker, the biggest, most dramatic price swings were happening over the weekend when all the traditional exchanges were dark. And this created a massive, terrifying problem for traders called gap risk. It's exactly what it sounds like. It's the risk that from Friday's close to Monday's open, the price moves so violently against you that, poof, your entire strategy is blown up before you can even press a single button. It's like your home insurance only working on weekdays. So what did they do? Well, they had to find a solution, and fast. They basically ran from the locked doors of Wall Street to the only places that were open for business, these crypto-native platforms. Because there, they could actually manage their risk in real time 24/7, 365 as the news was actually breaking. So how does this actually work? What's the tool that makes this possible? Well, it's a really fascinating invention that was born in the crypto world, but now it's being used to trade some of Wall Street's biggest, most important assets. It's called a perpetual swap, or what everyone just calls a perp. And the name kind of gives it away. See, a normal futures contract has an expiration date, but a perp, it's designed to last forever. It just keeps tracking the price of whatever it's based on. Gold, oil, you name it, without you ever having to worry about it expiring. And the magic behind it, the real secret sauce, is this clever little mechanism called the funding rate. You can think of it like a gentle magnetic force. There's this system of tiny payments that go back and forth between traders, and it constantly, gently pulls the contract's price back towards the actual real-world price. It's what keeps everything perfectly in sync, all without needing an expiration date. So where is all this trading going down? I can tell you where it's not happening. It's not on the CME, it's not on the NYSE. A totally new financial hub for these assets has basically popped up out of nowhere almost overnight. This whole new market is being run on crypto-native platforms. Binance has just jumped in and is completely dominating, capturing a massive 62.7% of the market. And then you have the decentralized exchange Hyperliquid, which is a distant second, but still has a really significant piece of the pie. And you better believe the old guard is paying attention. This huge shift in money hasn't gone unnoticed. I mean, you've got financial giants like Bloomberg scrambling to catch up. Just this week, they launched a brand new set of professional-grade indexes just to track these markets. They have to. They know this is where the price is being discovered now. And listen to this quote from the CEO of BitMEX, the company that literally invented the perpetual swap. He says, "This is a direct shot at the legacy giants." The message couldn't be clearer. Get on board with the 24/7 world, or you're going to get left in the dust. So let's pull back. What does this all actually mean for the future of finance? Is this just a temporary thing, a fad that was born out of a crisis? Or are we looking at the start of a permanent structural change in how markets work? Well, the data seems to be saying this is the real deal. Because even now, with things calming down a bit after a fragile ceasefire was announced, the money isn't leaving. In fact, what we call open interest, which is just the total number of active contracts, is still sitting near record highs. It's like traders came because of the crisis, but they're staying because, well, it just works better. And believe me, this is just the beginning. This whole perpetualization thing is expanding. The same technology is now being pointed at pretty much every other major asset class you can think of. We're talking foreign exchange, euros, pounds, yen, more commodities like natural gas, and even the really big ones like bonds and interest rate products. So this idea of being able to trade the world's most important assets with a ton of leverage and with absolutely zero downtime, it's not a niche crypto experiment anymore. For a huge and growing number of people, this is the main event. Which really leaves us with one final pretty big question, doesn't it? In a world that never ever sleeps, is the whole idea of a 9-to-5 trading day officially a thing of the past? It sure looks like the markets are finally catching up to the 24/7 world the rest of us live in. Thanks for listening.